Hi everyone, and welcome to another episode of the Evergreen Ratings Rundown. I'm Angela Ashton and I'm a Director of Evergreen Ratings. Today we are sitting down with Tim Slattery from ASA Real Estate Partners to discuss their Diversified Property Fund, or the DPF. So this fund has been rated by Evergreen Ratings as commended. Please be aware that ratings are only one factor to be taken into account when deciding whether to invest in a financial product, and any rating is subject to change. Our rating scale and research methodology is available on our website, so please have a look if you want to know more. And if you want to know more about ASA after this podcast, have a look at their website as well. So with that out of the way, I will introduce you all to Tim Slattery, who is Managing Partner of ASA Real Estate Partners. Thank you for joining us today, Tim.
Thanks, Angela. Great to be on and talking with you.
Yes, lovely to speak to you too. Let's get started with our first question, and let's start with the big picture. It's been an incredibly volatile time in markets. You know, we've had Iran and all sorts of geopolitical risk playing out, talk of potential stagflation, rates rising here in Australia, and so on. So a really different picture from one that many investors have been used to for probably much of their investing history. How does ASA look to navigate these current market conditions?
Look, absolutely. It's been a fairly volatile start to 2026. We do have the benefit, however, of, I guess within the team, we've, got the best part of 100 years worth of experience. So having invested through the global financial crisis, COVID, a number of other somewhat critical market events over the journey. Not to say that this time is not different, but, we have seen volatile market conditions before. The fund that we manage, the Diversified Property Fund, has been around for 20 years and owns a very strong portfolio of assets with a strong weighting towards convenience retail property. So, we've got an occupancy level sitting at 99.5%. The weighted average lease expiry is over 9 years. We've got Coles, Woolworths, Aldi as sort of major tenants. So we've got a pretty good level of visibility over the income for the fund, and it actually provides us quite a good, juxtaposition or counterpoint to the volatility we see in things like oil markets or stock markets with regular rental income coming through the fund. So we feel like this sort of market environment does provide an opportunity for investors to look at their portfolios and think about, real assets, what they can do for portfolios. We've found a lot of investors quite interested in the fund and commercial real estate more broadly, because it does have that physical aspect to it. It does have a level of a level of income security that is perhaps more difficult to find in the equities markets. And I think the other thing that's quite relevant is, with what you touched on before, we've seen bond yields up at nearly 5% for the long bond. So that is a significant change of settings, and one thing we look at really carefully in terms of fund and returns and what offers a good risk-adjusted return. The benefit of real estate and a portfolio like the one that we manage is that we've got roughly 85% of the leases have got fixed annual rental escalations or CPI-linked rental escalations. So you do get that inflation hedge as part of the, the lower volatility exposure. But yeah, it's certainly been an interesting start to the year, and no doubt the 12th of March now, so no doubt the next few weeks has got a bit more to play out, and it'll be interesting to watch to see what happens.
Yeah, absolutely. I think, in 2 weeks' time, we'll be talking about completely different things, which is, definitely keeps us all on our toes. I would agree with you, though, in terms of real assets, particularly, people are talking about stagflation now a lot. In that type of environment, lots of assets don't do well. You touched on bonds. Bonds, I haven't looked at what the monthly numbers are going to be, but if we assume that, the long bond sits at 5, stays at 5, this month's numbers are going to be awful for bonds. Equities are also, it's a tough environment for lots of equities as well. The advantage of something like this is, one, in terms of the tenant profile you mentioned, that's pretty defensive. I mean, people are still going to go to Coles. Even with inflation, they're still going to go to Coles. And the second thing is that inflation pass-through that happens in lots of real assets, not just real estate, although real estate is a great way to get that, also things like infrastructure as well. It can be a bit delayed, because obviously, those rental increases take a little time to come through. But I agree with you. I think in this type of environment, in this type of difficult environment, real estate and similar asset classes are definitely something that investors should consider. So certainly something that here at Evergreen we're looking at for sure at the moment.
Yeah, I think the other part to that, just on the rate outlook, is that a lot of property funds, but we also do this. We spend a lot of time on the interest rate risk management. So the fund's borrowings were 91% hedged as at December. So typically what we'll put in place is a series of interest rate hedges to make sure that investor distributions are not exposed to the change in cost of interest. And particularly in markets like this, with when we talked about long bond at 5% and where cap rates are, but the fund's gearing sits at around 40%. So that's another key kind of risk measure that I think people want to be looking at when they're looking at their portfolios, just how much risk and making sure that they are prepared to weather the volatility if that's what we see more of as the year unfolds.
Yeah, agreed. And a good point about the amount of gearing in the product as well. And certainly for people listening to this podcast, gearing ratios through any product like this you should be looking at. Okay, so let's talk a little bit more about then, I guess, the trends that you see emerging at the moment in commercial and maybe retail property, particularly around things like AI. How is that affecting markets as you see them at the moment?
Well, look, it's fascinating. There's probably 2 or 3 big things that we are looking at, and then I think a lot of investors are looking at as it relates to real estate. I think the first thing is that they have. This is not a. AI is a new technology, but if you think about I saw the headlines this morning. I think the phrase was AI apocalypse, which it's a great headline, and I'm not suggesting for a moment that it won't have an impact, but for people calling sort of the death of the office sector, our fund has a relatively minimal weighting to office property, deliberately so, given all of the the challenges and risks we've seen over the last few years. But that said, we don't ascribe to the view that the office is dead. I think there's absolutely going to be a flight to quality, but the best organisations, the best teams are still going to do their best work in great office space, and that means there will be an opportunity still to see well leased buildings and good returns. AI again, a new technology, but if one thinks back to the the advent of the internet and the mobile phone, it wasn't that long ago that people were using faxes and photocopiers. And those technological advancements didn't sort of curtail the death of the office, even though there's a fundamental shift in the way people work. So I think that's one thing to look at, and certainly some of the best opportunities are found when the market has got a strong consensus view in one direction, and if that's super negative on office, then we'll look quite selectively and opportunistically about how we can sort of potentially take a contrary view. And we've made the best some of the best investments when we've been prepared to sort of take a fundamental view on what represents good value and being able to act upon that. So I think that's one thing in terms of office space. We're not necessarily of the view that it's dead and buried, and it could well be an opportunity. I think the second thing is that absolute boom in sort of data centers in this infrastructure, look, it may well be a game changer, but the amount of capital going into that part of the market with somewhat untested, unproven returns. There's a number of relatively high profile examples in the Australian market. We're pretty cautious on that when we think about risk. We spend a lot of time thinking about long-term location, long-term fundamentals of the assets, how competitive they're going to be to continue to be able to generate a good level of profit for the business that are the tenants, that which underpins the rent. And that some of those things are pretty hard to form a conviction view around. And I think also that also means that it's a bit difficult to to be taking the view that this warrants a huge allocation of your capital when you just don't have the runs on the board to sort of necessarily prove that. So data centers and those sorts of parts of the market could well make good investments in isolation, but we may sound a little bit boring and conservative, but we would at the moment strongly prefer to have a well-leased neighbourhood shopping centre. If it's generating us 7% income with another sort of 300 basis points of growth through our leases, then we're very happy with that as a consistent long-term return. But that's probably the other thing I think it's worthwhile thinking about in terms of AI and the impacts for commercial real estate.
Yeah, you're right. There's definitely some really interesting headlines at the moment around AI, and obviously, job cuts associated with it. But certainly, I've been trying to vibe code something myself at night for the past few weeks, and I can tell you, maybe I'm just not a very good vibe coder, but I'm not quite sure that AI is really going to take over jobs. I think it can help. It can certainly help you with smaller things. But once you try and sort of, get a whole heap of more complex things together, it really does not cope well. And I've seen some very interesting things over the past few weeks that have been generated by AI, which would make you very scared.
Yeah, absolutely. And I think when we think about it, we think about what it can do today, and then we can think about what may be possible in,
of course,
6 months, a year, 3 years, 5 years, which I know is exactly the way that you guys think about it as well. So no doubt it will become more capable and it will be able to do more. But does it see a permanent and material shift in demand for office space? And we're talking about the best leased buildings with strong location profiles, newly established buildings that are going to appeal to a wide range of tenants. We think that is probably somewhat overstated in terms of mass job losses and white collar workers. I suspect that a lot of those workers may be able to be employed in other roles, and AI enabled or augmented roles that was sort of what we saw with the advent of the internet 20, 30 years ago.
Yeah, I think that's probably true. Work will change, but it won't cease.
Yeah, that's right.
Yeah. So when we're looking at direct or commercial real estate portfolios or investment, what do you think are some of the things that people should think about, that they should identify in considering what they might want to invest in?
Look, absolutely. There's a huge amount to that question. But I mean, the things that we look at, we look quite carefully at which sectors. So by that I mean we might be talking about industrial warehouses, shopping centres, office buildings, and other sort of related sectors in terms of self-storage, healthcare, other things. So we have a diversified fund, and that means that we can invest like a private equity fund or a private investor. If we think the best risk-adjusted returns are on offer in the retail property sector, then we'll deploy capital to that sector. Sort of the converse is, if you've just got an office portfolio, just got an industrial portfolio, it sort of means that no matter how high the valuation of those assets goes, or indeed how poor the outlook for future returns becomes for that sector, those funds have to remain fully invested in those sectors. So I think the diversification gives a real benefit to investors to be able to deploy capital. But we look carefully at the sectors, and I think, I mean, like we saw this with industrial, cap rates went to below 4%. It, obviously present an excellent opportunity to take money off the table. And then equally, on the back end of COVID with shopping centres, cap rates had adjusted upwards significantly. Rents had been rebased as all the COVID impacts had flown through, and they were an outstanding buying opportunity. So we look carefully at the sectors, then we look quite carefully at the sub-markets. I mean, we're based in Melbourne, but to use a sort of a Sydney analogy, the prospects for a Parramatta office market may well be very different from that sort of core CBD spine location for new office buildings. So the sub-market analysis is quite important. And the other thing we're really looking at from our fund's perspective is the key objectives. One is the income objective, and the second thing is the total return objective. So, can we generate a strong and growing cash flow from the investment? Then what are we playing for in terms of a total return potential? I mean, to use an example, we're just in the process of acquiring an office building. We've sold a retail asset at a mid-fives yield, and we're about to deploy into an office building at an 8% cap rate. So, 300 basis, 250 to 300 basis points of yield differential gives you a big, it's a big spread there. So that's something that we look at quite carefully. But then, there's a whole lot of other work that goes into the exact location, how strong is the leasing market, who are the tenants, how sustainable are their businesses, really what's underlying the particular asset, capex profile. There's a huge amount of leakage of returns through incentives in things like office buildings. I mean, we've seen leasing deals done on 60, 70% incentives, which in simple terms, means a 10-year lease. It's effectively, 6 years worth of rent-free. I know there's different ways to take incentives in terms of office fit outs and those sorts of things, but there's quite a lot to work through in terms of getting to a attractive cash yield at the end of it. I think risk is a key thing for people to look at. We touched on gearing before. That's a very big consideration, I think, for investors looking at the sector. And I think, finally, being really comfortable that the investment manager, unless you're choosing to go direct, but if you're choosing a manager, I think that's a critical part of the decision. People that you're comfortable with, that have got an established track record. I mean, we always say, past performance is not an indicator of future performance, but equally, I think for teams and organisations and firms that have got well-established experience and also strong alignment. I mean, we as the manager for our fund, we've got $20 million of the manager's capital co-invested in the fund alongside investors, and I really think alignment of interest with that is something that is a great sort of risk management tool for investors to think about and provides a good level of alignment. So those are some of the things that I would suggest would be on my checklist if I was thinking about making a commercial investment and with whom as far as my investment manager was concerned.
Yeah, a couple of points I'll expand upon there. I think alignment is something that any investor should look at in any sort of pooled investment, whether it be equity, fixed income, or anything else. Understanding the alignment between the investment manager and the fund is absolutely paramount. The more aligned you are, the better. So, for all of those, people sort of doing their own work out, as a result of something like this podcast, definitely ask those sorts of questions. How much of the manager's money, their personal money, is in the fund? And what is the company's policy around investment, in other direct assets or whatever it is? These are two critical things that we would ask of most fund managers as a general rule. And the other thing that I wanted to mention was when you talked about the team and the experience in the team, I do have to mention on a personal note, I have known your chairman for about 30 years.
You've obviously both, I mean, we've all seen a lot in different market conditions, but I think that really helps, when you think about, the financial crisis or COVID, and, we're applying it today to what we're seeing in Iran with higher rates and the oil price volatility, I think that experience does count, and I think for investors to know that the people that are responsible for managing a good portion of their life savings or their super fund, that there are sort of experienced, seasoned hands that are looking at the investment decisions and the market conditions. I think that experience counts for a lot. So I think that is critical. And obviously you've seen that, and Howard has seen a lot over the journey.
Yeah. Look, I know Howard's seen a lot. Like, I know that he's an experienced guy. I've certainly had heaps of conversations with him over the years, and I think he really does know property in Australia. So I definitely would point to him as being one of sort of the premier property experts in the country.
Yeah, I mean, I think we really like. Well, we've been very deliberate about how we've assembled our team. So between Alex and Chris and myself, and then we deliberately set up an independent board chaired by Howard and Annabelle McFarlane from JLL. So that the two of them are our independent directors, and they I think they've done an excellent job, and I think the governance is critical. I mean, it's a similar sort of concept to the alignment and skin in the game, but having having an independent RE is something also. Yes. I think that a lot of people would be well advised to look at in terms of how they're investing and accessing the sector. I know that's something that you guys paid a lot of attention to when you were looking at the fund and forming your assessment.
Yeah, independent RE, independent trustee, critical. You can probably miss 80 to 90% of all the issues in investing, in managed funds or pooled vehicles by looking for those two things. So yeah, another thing definitely to look at if you're thinking about this sort of asset class, or any asset class actually. So we're getting close to time, so let's talk a little bit about the fund. Can you maybe tell us a little bit about the fund itself and how you think it compares to some of the other funds out there?
Yeah, sure. Look, I mean, the fund, the ASA Diversified Property Fund, it would be one of the largest funds in Australia at over $500 million in assets under management. It's perhaps, if not the longest running, one of the longest running. This year in 2026, it celebrates its 20th year in operation. It's never missed a regular distribution payment, and it's certainly one of the best performing property funds over the journey. I think over the last 10 years, its annualized total return sits at 9.8%. For $10,000 10 years ago would be worth approximately $25,500 today, with the effects of compounding. It owns six properties. Majority of the portfolio is in convenience retail, so that's essential daily needs retail that we've talked about. Gearing sits around 40%. It pays a distribution yield of a little over 7%. It's paid monthly, and it will be 100% tax deferred. And really the target return for the fund is to generate a regular, consistent income, 7%. Plus, we should be generating another 3% or so from the annual growth coming through the leases. And then if we're successful in repositioning the properties, we have a very active management approach from leasing, refurbishment, and upgrading the quality of the assets, and then exiting them. That's additional value that we would hope to add. So, we've seen about $50 million of new capital committed to the fund over the last 12 months, which is great to see. And I think in terms of a risk-adjusted return, it obviously, given the strength of the leases and the occupancy and lease term metrics, it is in a very good position for people looking for a less correlated, lower volatility investment that's backed by real property, real assets. A number of the investors and groups that have committed capital over the last 12 months, there's a number of different rationales that have been part of their investment thinking. I mean, some of them invested as a source of income. I mean, it's highly transparent. You can see the leases, you can see the property owners, particularly as opposed to or compared against some private credit products that don't have the same level of transparency and income, I guess long-term income visibility. That has been a reason that investors have committed to the fund. A number of them have invested on the basis of the, I guess, inflation hedging benefits of the fund and what it can do for a portfolio. And then a number have invested as a sort of a ballast in portfolios. They've when Group I know they said, if we can consistently generate 10 to 15% over the long term, that's an outstanding investment, regardless of what other things I might be comparing it against in my portfolio, whether it's equities or other things. So there's probably a range of different roles the fund can play, but we're really excited about the outlook for the fund, and we're very heavily invested ourselves in it, as we mentioned with the manager co-investment of $20 million and strongly aligned with the outcome. So the fund sits on is accessible directly or via the major platforms, and we certainly think it's very well positioned to continue to generate strong risk-adjusted returns from the portfolio that we've put together.
Fantastic. Thank you, Tim, for your time today. We'll wrap up, I guess, the questions there. If anyone would like to get a copy of our full report, it's available from our website. You will need a login, which is free, but we do need to, for regulatory reasons, ask you to log in. If you would like information directly from ASA, please feel free to go to their website or contact them via the website or over the phone, whatever you would like. We will provide links to both your site and our site at the end of this podcast. So with that, I will wrap up. And thank you again, Tim, for your time.
No, it's a pleasure, Angela. Really nice talking to you. Enjoyed the conversation.
Yeah, no, it's been good. Certainly anyone listening to this podcast, please feel free to just give us a call if you have any questions. Thank you again, Tim.
Thanks, Angela.